Hi everyone, so my name is Tayan Rumaizan and we are from Group 6. So today our group will be presenting about our financial ratio analysis report on Mr. DIY Group and Berhad for the years of 2023 and 2024. So we will discuss about the company's performance based on key financial data and ratio analysis. So first of all, Mr. DIY was founded in 2005 and has grown into Malaysia's largest home improvement retailer. The company sells affordable household hardware and lifestyle products through more than 1,200 stores nationwide and in other Asian countries. It is also listed on Bursa Malaysia under Mr. DIY Group and Berhad, which also manage Mr. Toy and Mr. Dollar. The company's mission is to offer affordable prices and convenient shopping for all customers. So for the financial data summary, our data is from Mr. DIY's 2023 and 2024 annual reports. So we use the income statement and financial position to calculate the company's key financial ratios. So first is summary of income statement. So here we can see that revenue dropped a bit in 2024, but profit increased. Net profit went up from 481 million to 568 million and earnings per share also improved. Next is summary of statement of financial position in 2024. So total assets and equity increased. This shows that the company is growing. Liabilities also rose, but Mr. DIY still keeps a strong financial balance. So in this section, we calculated Mr. DIY's financial ratios to measure its overall performance for 2023 and 2024. So the data was taken from the company's annual report and will be analyzed into 5 main categories, which is liquidity, profitability, efficiency, leverage, and market ratios. So here we can see that Mr. DIY's liquidity ratios for 2023 and 2024. The current ratio improved from 2.23 to 2.38, meaning the company has more current assets to cover in its short-term debt. The quick ratio also increased from 0.54 to 0.68, showing better cash and receivable management. So overall, Mr. DIY became more liquid in 2024 and can meet its short-term obligation more easily.
My name is Emilia Namatu. I will explain about profitability ratios. Profitability ratios measures the company's ability to generate income relative to sales, assets, and equity. As you guys can see from our calculation here, it shows the company's profit margin rose from 10.02% to 12.23%, showing that Mr. DIY earned more profit for every ringgit of sales. Although overall income slightly declined, this increase reflects better cost management and higher operational efficiency. Next, we're moving on to return on assets, also known as ROA. ROA declined slightly from 16.3% to 15%, indicating that in 2024, Mr. DIY expanded their assets base by opening more outlets, which temporarily reduced their short-term efficiency. Nevertheless, the company still maintains a solid return on their overall assets. Next is return on equity, for short ROE. ROE slightly decreased from 30.3% to 27.7%, indicating a modest decline in returns to shareholders. Despite this downturn, the company continues to perform strongly as a ratio above 20% reflects solid profitability and effective reinvestment strategies. Next, we're moving on to efficiency ratios. Efficiency ratios assess how well a company uses their asset and inventory to generate sales. The total asset turnover declined from 1.63 to 1.22, indicating a decrease in revenue generated per ringgit of assets. This drop may be due to substantial investment in new outlets that are expected to deliver returns in the future. Nonetheless, it still reflects active utilization of assets. And lastly is inventory turnover. The ratio rose slightly from 2.59 to 2.70, indicating a quicker sales and inventory turnover. This reflects enhanced stock management and better inventory control, both of which are crucial for efficient retail operations. That's all from me.
Hi everyone, my name is Farfana binti Abdullah. So today I will be presenting about leverage ratios for Mr. DIY Malaysia. So basically, is leverage ratio show how much a company depends on debt to finance its business. For example, they tell us whether the company use more loan money or by using their own money. High ratios mean higher debts and higher risk, while a low ratio shows the company is more stable and safer. The first ratio is debt to equity ratio, which is the formula is total liabilities divided by shareholders' equities. In 2023, Mr. Dewa ratios was 0.86% compared to 2024. It decreased to 0.85%. This means the company used less debt and more by using their own money. It showed that Mr. DIY is managing its finance well and in a healthy position. Next is the interest coverage ratios, which measures how easily the company can pay its interest expenses. The formula is EBIT divided by interest expenses. In 2023, the ratio was 15.56 times, and in 2024 it's improved to 17.20 times. This means Mr. DIY earned enough profit to pay its interest many times over, and its performance got even better in 2024. Overall, both ratio shows that Mr. DIY Malaysia is in a strong financial position with a low debt level and a good ability to pay its interest. So here is the financials performance, which is the comparison between the years on 2023 and 2024. So first is we take a look at the liquidity. Both the current ratios and quick ratios increase, which means the company is getting better at paying its short-term debt. Next is profitability. The net profit margin went up, showing a higher profit, but the ROA and ROE dropped a little bit, maybe because the company has more asset after expansions. So next is for efficiency. The total asset turnover is decreased. That means the company earn less revenue per assets, but the inventory turnover improve, showing it's better stock control, being controlled. So next is in leverage ratios, which is the debt to equity ratio stay stable, and interest coverage also increase, and this shows the company is strong in paying its interest. Lastly is for the market ratios. EPS increase, and even though the PE ratio drops, the market is still confident with the company. Overall, the companies perform better in 2024, especially in liquidity and profitability.
Overall, Mr. DIY shows strong and stable performance. The company maintained good profitability and strong liquidity and low debt. For the market ratio, the earnings per share increased from 4.5 to 4.9 cents, showing higher profitability, while the price-earnings ratio stayed high, proving investor confidence. In liquidity, both the current and quick ratio improved, meaning Mr. DIY can easily cover short-term liability. For profitability, the net profit margin rose to 12.23%, showing better cost control and efficiency. Although ROA and ROE slightly decreased due to expansion, they still remain strong. Lastly, the debt to equity ratio stays stable, showing low financial risk.
Next, for my part, is factor contributing to improvement. Number one is strong strategic initiative. For example, focus on expenses, affordability, financial stability, and operational excellence. Number two is aggressive fiscal expenses. For example, 100 of the new outlets opened between 2023 and 2024. Number three is competitive pricing and product variety. For example, the slogan is value for money with affordable price. Next is strong financial foundation. For example, consistent profitability and dividend payouts. Number five is regional diversification and international growth. For example, expansion into Indonesia, Thailand, the Philippines, and Brunei. The last but not least is operational excellence and technology investment. The new distribution center and warehouse automation. Next is factor contributing to decline and risks. Number one is market saturation and weakening same-store sales, SSS. For example, growth mainly driven by the new outlet, not organic sales from existing store. Number two is rising operating costs. For example, increased expenses in rental, labor, and logistics due to expenses. The number three is investor sentiment and market valuation risks. For example, the stock performance show fluctuation and concern of overvaluation. Number five is intensifying competition. For example, face pressure from local discount chains, online platform, and important low-cost goods. The last but not least is international expansion risks. For example, entering new market, Thailand, Indonesia, Philippines requires local adaptation. Next is recommendation from management. Number one is priorities, same-store sales, growth, and category optimization. For example, focus on improving same-store sales instead of relying mainly on new store openings. The number two is strengthen supply chains operation and automation. For example, expands centralizes warehouse capacity to support nationwide distribution. The number three is adopt a more selective store expansions and experimental format. For example, use a selective data-driven approach for the new store openings. Number four is accelerate omnichannel integration. For example, develop a fully integrated omnichannel ecosystem combining physical and digital sales. The last but not least is enhance investor communication and expectation management. For example, improve transparency in financial and operational reporting. That's all from me. Thank you.
In conclusion, Mr. DIY continues to be a profitable, efficient, and financially healthy company ready for sustainable future growth.